So now, part 3, I'm talking about exit options and return on equity. So once all this revenue, EBITDA, valuations or dilutions and shares all settle, okay, you need to work on exit plan for your investors. So a lot of investors, they say, how do I exit? I want to invest into you, but how long is it for me to take back my return? Is that a dividends? Is that a share that I can sell? Is that a lockup period? So all these things is very important. Normally buy in the share, you lock them out for a few years, but during this few years, they want to see your company grow. They might not able to sell the share, or they might not able to have dividend, but they want to see at least your company have grown. Okay, so what is the options? Okay, exit option. There are few options for company. They might do M&A. What is M&A? Things like maybe they let me see. Things like M&A in the sense that they want to merge with some company. You merge with some company that they are actually synergy, your synergy partner. Again, I put back Airbnb as a very good example. Airbnb, they're tying up with a landlord and customer. Or what is the thing that give customer service more? Maybe they tied up with travel agency so that they can tour. So the company might be able to merge with a travel agency. Okay, so they use M&A, merging and acquisition, to increase the valuation. So when they merge the company, that time they need to raise fund. They need to raise fund, then raise more funds so that they can do this exercise. But when they raise fund, that time they are able to also retire some of the investor. Some investor, they say, okay, I have enough. I want to retire. I want to sell my share to somebody else to do all these things. So all these things have to work out earlier with the founder. The investor said 3 years down the road, I want to retire. What is my share price? What is my options? MMA is one of the options. But 3 years down the road, he said, no, maybe I'm going to IPO my company. I'm going to list my company so that you can sell your share in public area. So this is the thing. So how much can I share? How much can I sell for my IPO? You can't say, no, I'm not sure, I don't know, because all these things is forecast. You need to do your forecast, you need to do your plan, 5 years plan, 10-year plan, planning ahead of time, so the investor be able to see, the way, how potential is your company, so that they're able to invest into you. So you have to calculate, how much is your IRR, internal return of investment. How much is your IRR? IRR will be affected. The longer you drag, the lower is the IRR. So I give you one good example. How do we calculate IRR? This is another company, they are dealing with biotech, biopharma drugs, vaccine, what they call vaccine, right? So vaccine company, normally they do a lot of what they call R&D, a lot of research and development. There's a lot of clinical trial. There's no profit from the very beginning. So you can see that there's no dividends at all. And do you think that the investor don't like this kind of company? Maybe there's no dividend. So you need to find out what kind of investor. Different investor, they have different appetite. Some investor, they don't like, they want, okay, 2 years down the road, I must have my dividends, fast food company, maybe very fast turnaround time, I have dividend in 2 years time. R&D for this vaccine company is too long, 5 years, 8 years down the road, only I have dividend. That's too long, I don't like. But after 5 years, maybe the boom, the share price will increase by 1,000-fold. You never know, instead of $1 share price, they become 500 share price, that kind of potential. So you got to ask your investor, what kind of appetites do they like? Angel investor, maybe they like dividends. Okay, sophisticated investor, maybe they like share growth. So like they have different kind of option and different kind of appetite. So you need to find out, okay, from there. But all these things you need to work out. What is the valuation? What is the share price? What is the IRR? And what is your growth? Potential growth, potential business growth as well. Then what content from here, you put everything into your pitch deck, okay? A pitch deck, I believe everybody know what is a pitch deck, right? A simple pitch deck, a lot of investors, they don't like something that give them a 30 or 50 pages kind of pitch deck. Nobody want to read your pitch deck on that. So you got to do something that pitch deck very, very simple. So this is something that 10 very important point, you're able to put into your pitch deck, things like your company value and proposition. What makes you so special? Why people want to invest into you? What is your value proposition? You have to think, okay, what is the problem and solution? Why are you trying to solve this problem? Okay, what is the target and opportunity? As what I say, your TAM, your SAM, and your SOM. You have to work out your market value, market opportunity. And what is the business model? How do you make money on that? Okay, it's not just about very straightforward, I'm selling product, but what is the strategy? Your strategy to come up with your business model. And what is the traction? Have you done something? Have you done the traction and validation? Have you done your prototype and validate it? And what is your financial roadmap and milestone? It's very important. It's not just about now. It's not about, I have a good idea, I'm going to do something right now, we're going to plan right now, but you need to plan in future, minimum 3-5 years down the road, and your milestone. Okay, then you work backward. You look into my macro, then you work backward. Okay, in the long term, then you work backward. Then from there, you work backward. Every stage, you know, the series A, just now, earlier I'm talking about series A, series B, C, and D, that kind of thing. Every stage, there is a value. Every stage, when there's a valuation, there is a fundraising as well. Okay, so you got to see it. Beginning stage, you talk to angel investor. What is my funding? What is my use of fund? What is the money for? Okay, you raise for $500,000. What is a $500,000 for? And what is this $500,000? What are you going to achieve? How much are you going to achieve? What is the EBITDA? What is the valuation? So three, very important. How much are you going to raise? What are you going to achieve? Very important. Investor, they want to know this. It's not just about paying salary. Investor will not want to see your money is paying the salary. So it's very important. I know the founder, a lot of people, they put in many for of their times, you know, 24/7 of their time into business, into their startup business. However, they have minimum pay. Okay, that's the reason you need to put in extra effort. You cannot take 100% of your salary just to grow your business, just to pay you. Always remember, investor money is to grow business, not to pay salary. Pay salary is just for you to have your what you call a breathing space, give you some oxygen to breathe, but it's not to feed your stomach, right? Okay, so very important, fundraising and use of fund. Okay, number 9, team is very important. A lot of people, they have a good idea, but they don't have a good team. You might know this friend A, no friend B, but they have never worked together before. So investors want to know, have you worked together before for some project? What is a project have you worked before? And what is the traction of your project? Okay, so not only good idea, team effort is very important. Then from there, what is the exit plan? Okay, I invest today, what is the exit in 3 years down the road? Okay, because they're comparing, what should I invest into a company? Should I invest into A, B, or C? They can compare in terms of their value. All right, so prepare the above. Okay, this pitch deck, before you have the pitch deck, these 10 things, you have to summarize it into a teaser. So what is teaser? Teaser is about 1 to 2 pages, A4 size of summarize of your business. Okay, we call it elevator pitch, you know, in short form. You know, why elevator pitch? Why they call it elevator pitch? Why elevator? Because it's 60 seconds. Normally, you're in the lift from top to bottom or bottom to top. They give you 60 seconds, the lift open. So what they're trying to do is in the lift itself, in 60 seconds, try to tell investor, what do you want? Okay, to pitch about yourself. Okay, to pitch about your business, try to tell investor, what do you want? Your idea, your traction, and on this 60-second elevator pitch, you're not asking them to invest into your company. The objective is for them to tell you, yes, tell me more. Just to get them to tell you more. You know, they want to know more, but they doesn't say that I'm going to invest into you. No way you can tell them to invest into you in 60 seconds, but you want to attract them curiosity. Okay, they're curious about your business to tell you more. Then from there, if they're curious about that, you give them the teaser. Then they say, yes, why not? Then you give them an elevator pitch. So you give them a pitch deck, about 20 pages of pitch deck. Okay, then from there, they say, yes, I'm very keen on that. Then you go into detail. They will look into your numbers. Okay, that is how your term sheet, your IM, your business model, everything spelled out. And some company, they might need to sign them NDA, example for biotech, biopharma company, they have a lot of IP protection, so they might want you to sign certain NDA, the kind of thing. So this is a thing that is very important once you have the idea how to fundraise your business. Yeah. So the target the right investor. As I say, from series A to series B, C, D, E, F, G is all different investors. So you have to know which is the right investor for which level or what stage of your fundraising. Angel investor or seed investor, they are from very beginning, very, very beginning. Okay, angel investor, they come in, maybe they can give you some $500,000 or maybe 50,000, but they don't really help you to strategy. They have no idea how to strategy, but they have money to help you to go through a little bit. Then from there, you have a little bit of traction. Then you start to talk about venture capital or family offices. That is how you have to really look into your numbers, your future values. Okay, then from there, private equity or investment banker. So how do you look for all these things? You go into PitchBook, you go into Crunchbox and look in that, which is an investor invest into the company like yours. Your company could be EdTech, could be IT, or could be property, it could be biotech, biopharma, so look into keyword, look into this kind of company and see what kind of investor have that kind of appetite. Right? Because if you are doing biopharma, for example, biopharma, biotech, you're going to hold minimum 5 years, 3 to 5 years, that kind of thing. And you talk to the investor, they want immediate returns, So the immediate return would definitely reject your proposal. It's not because your business skill is no good. It's not because the business model is no good, because it's a different appetite. It's just not the right fit, so you have to look for right fit. If you're a biotech company, you look for biotech investor. Okay, if you're a property company, you look for property investor. So it's a different investor match in different people and different portfolio. Yeah. So one of the things that, a lot of times used to be a lot of investors, they're actually investment banker, private equity, or family offices, that kind of thing. But COVID had changed a lot of things, This is something that you can find, the rise of newly empowered individual investor. Okay, this is high net worth investor, individual household investor. You can see 34%, this is in US, yeah? 34% of investor, they're actually household investor, means they're individual high net worth investor. Okay, they might not be in company. So company-wide, they become smaller right now. The reason why there's a lot of high net worth investor nowadays, there's few reasons. One reason is because fully accessible. Investment is just a few clicks away. They can invest. They don't need to go through a third party. They don't need to go through an agent. They don't need to go through a fund manager anymore, because investment becomes so easy to invest. So people is easy accessible, and people, a lot of education provided, and these people, they are knowledgeable to invest into the company. So one of the good example, when you look into investor, you look into high net worth individual investor. That could be things that will be able to help you. Yeah. Right. So next. Okay. And also, you see why people invest into you. What is different? Instead of invest into A, I invest into B, because a lot of things that you're not just invest for profit, but you invest for impact. So look into some company that they invest into impact, like what you're doing. For example, FutureLab, they're doing something for equal education. How do we provide more education for uni students, for high school level, also find talent for company as well. So we do something for impact, for quality education. So look for some impact, this sustainable goal, this 16 goal, which is the one that is actually aligned with your business, so that you can incorporate into your business model.